and you know even if you just invested in the peak of '08, you most likely still ahead of the market right now. So in the long term, stocks still work.
Hi, welcome to the Beat and Ask series. I'm Alvin, the founder of Dr. Wealth. Today we have a special guest, Stanley Lim. He's the founder of Value Invest Asia, and he's an ex-Motley Fool analyst. He's also a CFA charter holder, and recently he wrote a book, Value Investing in Asia. Okay, thank you, Stanley, for being in the show.
Yeah, thank you very much, Alvin, for having me.
Why don't you tell us a little bit about your background in investing, how you first got started, and why do you start Value Invest Asia?
Right, I think when I first started investing, the motivation is the same for most people. I wanted to have more money because when I first started working after my university, my first job, I was still working in Malaysia. So my first job was salary maybe around 500 Sing dollar a month. And I knew that's not going to be the long-term plan. And I remember when I was a kid, I read this book by Robert Kiyosaki. I think a lot of people read it, Rich Dad Poor Dad, where he talked about the 4 quadrants, right? So we have to become either a business person or become an investor. So that's really how I get started interested in my investing, and then learning about books from like Intelligent Investor or Security Analysis, although that's a very dry book. But from that, I become a value investor, yeah, basically.
Okay. And why do you start Value Invest Asia?
The portion why we start valueinvestasia.com is because basically we see when we are investing, if we want to look for information, say from the US market, it's so easy, right, to find stocks information, but it's so hard to find information about Asia stocks. And yet we are very optimistic about the future of Asia and the Asia stock market. So we really want to become the information provider to just talk about more Asia stocks and give people more in-depth research about Asian stocks. Yeah.
Okay. And thank you for the book. I read it, I like it, and you really give a lot more perspective about Asia. Because I read a lot of books that are mostly from US, and definitely they talk about the US stocks a lot more than Asia. And you have brought in a context about Asian companies being a little bit different, right? Let me ask you, since you're so bullish about Asia, do you only invest in Asia?
No, not really. I invest in the US stock market as well, just because there's so many high quality US companies, right? I think right now maybe my allocation to the US stock market is about 20-30% to US, but also I invest a lot of China companies that's listed in US.
I see.
Yeah, so that's combination of all US listed stocks. But having said that, I think it's just a personal choice where you want to invest in, and we are still predominantly Asia based, and I'm still very optimistic about where Asia is going to be in the next few decades. That's why most of our stocks is still in Asia, and we want to promote Asia as a financial institution and stock market as well.
Okay. So if you really want to know why are they so bullish about Asia, you all should get a copy of the book or at least follow their website, right?
Yes, thank you.
On that note, right, you did mention the companies are a bit different in Asia, especially the corporate structure, right, which they're more family-owned kind of structure compared to US, where they have more professional managers who run the companies. So in that sense, right, do you use more different kind of ways or processes to evaluate these kind of Asian companies with high family controlled entities?
I wouldn't say the process is different, but rather we place more emphasis on understanding the management and the major shareholders. Whereas when where we invest in US stock market, we might not even care who the main shareholder is, right? But that's not the case in Asia. We have to check who the main shareholder is. A lot of times, I'm not saying that family-owned business is bad, right? That's not really what I'm trying to convey. Some of them is actually pretty good, well-run, and I think being family-owned, it actually aligns the interest with shareholders, right? Because as a family-owned business, you want the business to be better. But just that many businessmen, maybe especially from the previous generation, they don't see minority shareholder as a fair partner, right? They only see that I build out the business, you're just buying my stock, why should I treat you fairly? That's their mentality, and when they do that, then maybe sometimes they overpay themselves, sometimes they have their whole family, their akong ama all in the company, right? And also sometimes to more extreme, they have many related party companies where just they are using that to channel the profit away. So these are the things we have to look out for. The best scenario actually, I think, is to find a family-owned business, but a shareholder who is friendly to minority shareholders. Yeah.
So basically what you're saying is that you're looking out for signs that the management is not on the shareholder side.
Yes.
Right?
Yeah.
Things like you mentioned, they have a lot of big board with their own family members, they pay themselves high salaries. So these are telltale signs that you would actually avoid these companies altogether.
Yes. Yeah, definitely.
One of the most common question is how many stocks should one invest in, right? So there's a school of thought where they believe that concentrated portfolio, let's say less than 10 stocks is the way to go. But there's also another group who say that no, you should diversify a portfolio to 30 or even 40 stocks so that one stock doesn't kill you, get it wrong. What is your take on this?
Personally, my portfolio allocation has morphed over time. Like over the past decade, I morphed from a concentrated investor to become a diversified investor. So now maybe I own 40, 50 stocks. The way why I do it is because as a retail investor, I don't want to just spend so much time understanding and following one company. So I spend enough time to understand the company, and then I take very small position. So if anything happened to the company, I'm not deeply affected. That's why I have a diversified portfolio. But and also from personal experience, last time I used to have very concentrated ones, and one mistake can really set you back a huge amount. Rather now that even if I lost 100% on one stock, it's just 2-3%. It's still okay. Yeah.
So which means you're keeping around 40 to 50. That's your optimal number, not beyond that, right?
Yeah, hopefully. I've seen some professional fund managers who have like 300 to maybe 1,000 stocks. But I don't think as a retail investor, I have the time to really just follow that kind of strategy. And I want a life outside of investing, so I'd rather not have that kind of portfolio. Yeah.
Okay. I know which one you're talking about. So to date, right, how well has your portfolio been doing for you?
So just on my own personal calculation, for the past decade, maybe my portfolio is ranging around 12-15% a year. I'm not super aggressive in my portfolio, and most of my portfolio is still in what you say income stocks. So I focus a lot on high quality growing companies.
So speaking about growth companies, I know you have a few different kind of companies that look at like income, like value, right? And you mentioned that out of so many, growth is the trickiest to identify. Is there any way that a retail investor who is interested in investing in these growth companies, right? What can they do to improve their odds of finding a real growth companies?
Right. When you talk about growth company, I think it kind of link back to your portfolio allocation. And from the book, like you rightly point out, we say that in the stock market, I feel mostly there's only 3 types of value, right? Asset value, income value, and growth value. And how I personally invest in growth company is I make sure I have a core portfolio of income stocks, high quality income stock first, maybe 50 to 80%, which are all in income stocks. And then I play with the 20 to 30% allocation on growth company, so to limit my risk. And when it comes to growth company, I would really focus much more in the management and also in just the growth opportunity of the company. And I make much more bets. So maybe for income stocks, I invest 3%, but for growth company, I would just invest maybe just 1%, but many bets.
I see.
Yeah.
So in other words, there are 2 ways that you have the processes to help you limit the impact of a growth stocks if you chose it wrongly, right? So one is that don't allocate a big proportion of your capital to growth stock, and you said for yourself it's about 20% or 30%, right? And then even with this 20-30% capital, each stock that you invest in is a lot smaller than what you would have if you invest in dividend stock or income.
That's exactly. Yeah.
Okay.
That's how I limit my risk. Of course, it's based on your own preference. If you're someone who is already financially free, you can take more risks. There's no reason why you cannot have 100% growth stock. Yeah.
But the opposite is that usually people are financially free, they are more conservative.
Yes, to protect your nest egg. Yeah.
So you'll just buy all income. Why do I need the growth anyway, right?
Yeah, exactly, I think.
Okay. I believe you have heard many advice regarding investment, and probably there are good and bad ones. So what is the worst one that you ever heard?
I think the worst advice I ever heard is actually cash is king. I don't believe in that. mainly because I just see stocks or property or anything else just as a different asset for you to store your wealth. And cash by far, I think, is the worst store of wealth. When you just look at some of the billions out there, like maybe Warren Buffett or Robert Koch, when they say they are worth 20, 30 billion dollars, they don't hold 20, 30 billion cash, right? Most of it is actually in stocks. And so the idea is stocks actually appreciate in price over the long term, whereas I'm pretty sure cash will just depreciate away in the long term. Yeah. So
that's quite a controversial one, because you're right in the sense that there are a lot of people who believe that by holding cash, in case the market crash, they can buy a lot of stocks.
Yeah.
Do you really see that happening to those people who really hold a lot of cash, daring to buy all these stocks when the market crashes?
In theory, it works like that, I think. But in practice, when everyone is panicking, I think it's really harder to do. Yeah. And to me, it's precisely the fact that I know in the market crash, I might not have the guts to invest so aggressively. So I rather just stay invested. And from I'm sure we've gone through 08, and you know, even if you just invested in the peak of 08, you most likely still ahead of the market right now. So in the long term, stocks still works for you. Whereas if you hold 100% cash, I'm pretty sure 10 years from now, you will not have any big impact on your portfolio.
So besides bad advice, right now let's go to the good advice. You've been investing for so many years. I believe there are many lessons that you've learned. Is there any one particular lesson you think would be beneficial to share with the audience?
I think the most the most takeaway from me after investing for so many years is really to have the patience to stay invested. Many people who invest, they kind of have the try and see mode, and after a few years, if they don't see any meaningful return, they might say that it's not worth their time. But that has been the case for me. Like in the first 7-8 years, my portfolio doesn't generate a lot, and it's not meaningful return. But just give it time, and maybe once you reach a critical mass, you will really start to see the snowball effect, and that's how compounding works. And if you don't have the patience to wait for it, if you quit sometimes in the middle, to restart it is you will probably wasted another decade.
Thank you, Stanley, for your wonderful insights to a lot of the questions, and I particularly like the bad advice on holding a lot of cash. So personally, I also think that it's not easy to buy after a market crash. Yeah. And hopefully these kind of things that we share during these kind of interviews, that you are able to reflect on it and probably help you become a better investor. So thank you again, once again, thank you, Stanley.
Thank you very much, Alvin. Thank you.
Thank you.